As many of you know, we are always very thrilled to be hosting this conference at the West Virginia University Chambers College of Business and Economics. And just because this year is our first virtual conference of the 27, we're just as excited this year, and we think we have an outstanding lineup for you. Just a quick overview, we're going to start with a discussion of the U.S. economic outlook, and for that we have Thomas Barkin, who serves as president of the Federal Reserve Bank of Richmond. Then I'll come up and I will provide the state economic outlook, and I'll be followed by Mark Mukow, Deputy Secretary of Revenue, who will discuss the public budget situation for West Virginia. And then the second half of the conference will be hosted by David McKinley, who serves as President and Chief Investment Officer at McKinley Carter Wealth Services. And he will host two panel discussions that will focus on special topics that are really of great interest for our state as we come out of this COVID economic crisis and pandemic. So it's a really awesome lineup that we have, and I don't think the quality has diminished at all despite the online format. We have a lot of stuff to discuss. But before we get started, I'd like to introduce Javier Reyes. He serves as Milan Pushkar Dean at the WVU Chambers College of Business and Economics, as well as Vice President for Startup West Virginia. And he's going to offer some introductory remarks. So I'll turn it over to you, Dean Reyes.
Thank you, John. Thank you for having me and for hosting the event as always. Welcome everyone. It's definitely a different type of event given that we're doing virtually, but I still wanted just to take a few moments to welcome all our panelists, thank them for participating with us, as well as all the attendees. Definitely a different kind of day for West Virginia, not only because of what you're going to hear about and how the pandemic may be affecting our economic engines and how the global markets and the economy is also being affected, but I also want to make sure that everyone keeps in mind a few of the great things that the state of West Virginia has been going through in the last couple of weeks. It's an interesting situation to be going through this pandemic that is affecting all the aspects of the economy as well as of our lives. But West Virginia is a state that has perhaps uniquely put together all its efforts and kept them aligned as we go through this pandemic, not to only take care of our citizens and our industry, as well as our markets and and everyone in the economy, but also to look to the future and make sure we continue to work to attract that kind of innovation that we know we started to look for a few years back when the universities across the state, in Marshall University and WVU, joined forces to create West Virginia Forward. And actually now we can see that West Virginia has indeed moved forward in some areas, some of them being the idea of a remote work environment that we are creating and a program that will be created that comes into place later in January, early next year. But at the same time, the big announcement that was made late last week about Bridging Hyperloop moving its certification center and establishing it here in West Virginia in the Tucker County area. It shows us that we may be going through some of the big frictions and the big challenges that the pandemic has put forward to the whole world economy. But at the same time, it shows that West Virginia, through West Virginia University, through Marshall University, and through our state leadership, have continued to keep our eye on the ball and make sure that we continue to push forward with this idea of innovation, startup, and entrepreneurial thinking when it comes to the state of West Virginia. So as we go out throughout the day, I still invite everyone, as you look at these numbers and as you hear from the great remarks that you can and messaging that our panelists will bring, to not lose sight of there is a now, and those challenges that we're addressing now are very important, and we need to keep attention on how we take care of the well-being of our state. But at the same time, there is a future, and that future seems bright for the state of West Virginia, and I invite everyone to continue to keep that kind of momentum and make sure that we look to the great things that are happening across the great state of West Virginia in collaboration, from starting with the governor, going through his cabinet, going through the universities, our congressional delegation, the legislatures, the industrial leaders and business leaders of the state. We're all clearly connected, and it shows by the attendance today that is the case. So thank you, everyone. Thank you, President Barkin, for being here with us today. We truly appreciate you taking the time to come talk to us and present to us the global perspective, as well as the rest of our panelists. I wish you the best. Godspeed as we go through this webinar. And thank you again, John, for your great efforts to keep this important venue and platform and work with David McKinley to make sure that it continues to provide that connectivity across the state, which has been a common denominator throughout the years. And we truly appreciate what the Bureau of Business Economic Research has done and continues to do as we go through these challenging times. But we seize the opportunities that we see ahead. Thank you, everyone, and have a great day.
Thank you so much, Dean Reyes. We really appreciate those remarks. So I just want to mention to the audience before we begin with President Barkin that we would invite you to submit your questions through the Q&A function. You should be able to find a Q&A icon at the bottom of your screen, and feel free to submit questions through that function at any time during President Barkin's remarks or any of the remarks throughout the morning. And at the end of each speaker, someone will read those questions to the speaker, so the speaker will be able to address the questions at the end of his time. And just to note, Brian Lego will be curating the questions for the first half of the event, and he serves as research assistant professor and economic forecaster in the Bureau of Business and Economic Research. So he'll be on at the end to present those questions. Anyway, we'll keep moving forward. So President Barkin, President of the Federal Reserve Bank of Richmond, for the U.S. Economic Outlook.
Thanks, John. It's great to be back here in Charleston, at least virtually. And thanks, I saw on the participant list one of my directors, Bill Loving, and one of my former directors, Pat Graney. So thank you to you guys for your service to the Fed. I thought what I might do today is just share some perspectives on where the economy is, how we got here, and where it might be headed. These are my own thoughts, not that of the FOMC or the Federal Reserve System. That frees me up to be as direct as I want, and I'm looking forward to any questions and comments you have at the end. My background comes from business rather than research, so I hope you'll find at least some of these views and experiences relevant. Let me start with the data. Given the steepness of the drop during the downturn, trying to interpret any rebound in growth rates is confusing. So I prefer to talk levels rather than rates. In other words, where are we today versus where we were pre-COVID? So let me start with cases. The 7-day rolling average of cases per day nationally, as of October 12th, was 50,000. That's higher than April's peak of about 32,000, but lower than July's second peak of 67,000. The unemployment rate is 7.9%. That's up from 3.5% in February. 11 million fewer Americans are employed. That's down 7.1%. Now, spending, I think, is coming back faster than employment. Last week's Richmond Fed CFO survey had employment coming back at about a third the rate of revenues. So against the 7% reduction in employees, real personal consumption expenditures, that's 2/3 of the economy, is down 4% from its January peak. Our best proxy of business investment, which is new orders of non-defense capital goods excluding aircraft, is up 1.9% since February, though it was lagging at the time. And of course, government spending is up 30% since February, as fiscal policies attempted to bridge the downturn. Inflation, we look at 12-month core PCE inflation, is 1.6%. That's down from 1.9% in February. So those are the numbers. Let me talk a little bit about the dynamics behind the numbers, because they've been complex. Of course, back in April, we shut the economy down. Spending plummeted, so did jobs. We've talked a lot over the last few decades about the shrinking number of middle-income jobs and the growth, which has been both in the higher end, in the cognitive technology-oriented jobs, and the lower end, which have been disproportionately personal service jobs. And sadly, this recession has directly targeted those at the lower end of that barbell, the personal contact service workers, who are disproportionately young, disproportionately women, and disproportionately people of color. So we reopened in May, and we also brought extraordinary fiscal stimulus to bear. And that has, of course, bridged a number of those who were laid off. It's also led to an unprecedented increase in our savings rate. Personal income year to date is up almost 3%, despite an unusually sharp downturn, because of enhanced unemployment and direct distributions to households. And people like me who sheltered at home found that their spending declined dramatically. Net, the savings rate increased from 8% pre-COVID to 26% in the second quarter. Excuse me. It was still 14% in August. Now, those who had elevated savings couldn't spend on services the way they used to. They weren't taking trips. They couldn't get a haircut. So they paid down their credit cards and they rotated their spending toward goods. And manufacturers have clearly benefited from that. Goods spending is actually up a little over 5%, while services spending is still down a little over 8%. Low rates have likely helped. Interest-sensitive sectors like residential and automotive have been booming. On the other side, decreased mobility has clearly hit the oil and gas sector particularly hard. These developments have driven mismatches in the job market. Unemployment, as I said, is quite elevated on a historic basis. But I talk to employers in places like manufacturing, technology, and healthcare that say they can't find workers because these lower income service workers, think waiters, don't yet have the skills for those jobs that are available. You also see very different impact on geographies. Unemployment in West Virginia was 8.9% in August, actually a little bit less worse than the national average than it had been before the downturn. But you can go to states in my district like Virginia that had 6.1%, and there are 10 states in the country that are still over 10%. Large parts of Asia appear to have largely recovered, while the US is still struggling. So that's how we got here. Let's talk a little bit about where we're going. And I just caution that I think somebody said that they invented economists to make meteorologists look good. So, predicting the path of the economy is never easy. But I'd argue it's harder now with virus uncertainty, with fiscal uncertainty, and with political uncertainty. And so 4 areas that I'm watching. First is the path of the virus, of course. On the positive side, hospitalization and death rates are dropping as infections skew younger and treatment protocols improve. Vaccines are becoming ever more proximate, though their ultimate approval, rollout, and effectiveness are hard to predict. All that said, the persistence of elevated infection and the risk of a second wave have both psychological and practical implications. On the psychological front, an elevated case rate raises economic uncertainty, and that affects businesses' willingness to hire or spend or invest. You've probably noticed a number of recent layoff announcements in industries as different as travel and leisure and even insurance. On the practical front, significant parts of the economy remain capacity constrained, which reduces its potential as well. The second thing I'm watching is the size of the skilled labor force. Now, participation in the labor force is at 61.4%, roughly 2 points below its rate in February. As always happens in a downturn, it dropped as people who lose their jobs choose not to look for another one, though perhaps less than normally expected given the availability of enhanced unemployment. But after an early bounce back, it dropped again in September, particularly among prime-age women. Another way to look at the situation is that unemployment adjusted for the drop in participation is still 11%. Are escalating care responsibilities at a time when childcare and schools may be closed or remote and elder care facilities are perceived to be less safe, making it difficult to commit to work? At the same time, will baby boomers leave the workforce given what they may perceive as increased health risk? Will service workers be able and willing to make the investment required to reskill themselves? Without strong participation by women and those 55 and older, and a better skills fit, our recovery will be limited by an inability to get workers. The third thing I watch is the normalization path for savings. Now, as I said, there's a lot of money in people's pockets. That is cushioning the cessation of fiscal stimulus. It could propel the economy at some point. I saw a recent estimate that it's as much as $1.1 trillion that is excess liquidity in people's pockets from before the downturn. But getting back to normal is going to require people to be confident they can travel, go to movies, and eat out without putting their families at risk. And once there, will these excess savings come into the economy suddenly or gradually? It's a pretty unprecedented event. The last time we had savings rates like this was World War II. And at the end of World War II, there was a real boom with a lot of money coming into the economy. But I don't know if that fits what most models suggest. Most models suggest that this money comes back somewhat more slowly. So I'm watching closely the potential for pent-up demand to boost the economy. You may remember after 9/11, President Bush encouraged us all to go shopping in November and December, and that holiday season was one of our strongest ever. The fourth thing I watch is inflation. Through the last cycle, inflation stayed stubbornly below our 2% target. The price level actually fell slightly from February to April before rebounding strongly over the last few months. On balance, over the last 12 months, core PC inflation has remained moderated, as I said earlier, suggesting this rebound may just be a return to trend. But one could also imagine other scenarios. Businesses are making their stocking decisions for the next few quarters in a time of both demand uncertainty and supply uncertainty. I sense they're being cautious, and that reading would be consistent with the retail trade data, meaning we're more likely to see stockouts than excess supply. If a demand surge were to happen, at the same time as we have supply shortages, that could affect first half pricing. And in our CFO survey, the CFOs we surveyed hint at some of this escalation. Speaking of inflation, the FOMC recently announced changes to our 2012 statement on longer run goals and monetary policy strategy. We've said in order to anchor inflation expectations at 2%, we seek to achieve inflation that averages 2% over time. It has modestly lagged that target for a while. In his speech, Chair Powell called this flexible average inflation targeting, and the flexibility comes from the lack of a specific formula. In addition, the committee said we would respond to shortfalls of employment from its maximum level. In the earlier version, it said deviations of employment. In other words, a low level of unemployment alone would not lead to preemptive increases in interest rates. Finally, it made explicit that meeting our mandate requires a stable financial system. Obviously, the net of all this is that the Fed will aim to keep rates low until such time as we see moderate overshoots of inflation or the development of financial stability risks. Our statement a couple weeks ago reinforced that message, which was supported by our projections in which the median respondent didn't have a rate increase through 2023. We also continue to engage in significant bond purchases that provide additional accommodation. To close, I remain hopeful we can put this virus and the related uncertainty behind us. If we can, as I said, there is untapped consumption which could give the economy a real lift. And in the interim, the Fed continues to do what it can to provide support. So thank you, and I'm glad to open it up to questions and comments.
Okay, Chairman Larkin, we have a question from the Q&A, and it starts off with, aside from real estate and retail loans, what concerns do you have about the community and regional banks?
Well, first of all, thank you for the promotion to chairman, but I'm definitely not a chairman.
No.
So let's start by saying that the last crisis was a banking crisis. And I think we all learned a lot from that. There was new regulation put in place. And at least at this point, this is not a banking crisis. We did a stress test of the 33 largest banks in the middle of the shutdown, put against very severe adverse circumstances. And all of them ended up with enough capital to make it through. So I'm really encouraged that the banking system has been healthy. I'll also say that in a lot of states, the community banks and regional banks played a very meaningful role in rolling out the PPP program, which I think has been a very successful program targeting small businesses. Of course, you've got to watch everything closely. And you mentioned real estate. That's certainly a sector that's got some challenges. I'd say another challenge is just compressed spreads. With rates as low as they are, that does compress the margin for banks. Those that are in small business lending or corporate lending obviously need to watch the question of those charge-offs. And on the personal side, there have been a lot of forbearance programs allowing people to defer paying their credit card bills or even their mortgage payments. And we're watching closely how much of those come back current now that those forbearance periods are ending. I have to say what I've heard so far is actually pretty good success, probably underwritten by the stimulus. Like I said, there's a lot more money in people's pockets, and that's probably allowed people to pay down their debts and continue paying their mortgages. But, if you have an extended period of unemployment that heads into next year, obviously that's going to put some of those at risk.
So the next question deal with bond prices. And the question is, are bond prices likely to remain competitive through 2021 due to the low interest rate environment?
Well, you probably ought to go somewhere else to predict, bond prices or yields. Obviously, the bond market's affected by multiple things. We've, I think, been reasonably clear on our point of view on interest rates. And so on the short end of the bond rate, I think that ought to be, well communicated, I think, to the public. The longer end is driven by a lot of other things. It's driven by people's perspectives on inflation. It's driven by people's perspectives on the health of the economy. It's driven by the flow of funds globally, and people's perspective is the U.S. as a safe and stable place to store, invest in safe assets. And so I think there's a lot going on there, and I wouldn't want to hazard a guess on that.
And finally, it seems this question corresponds to the Fed's perspective on fiscal policy. And the question's asking, it seems that the Fed is starting to dabble in fiscal policy. Is that the case?
Well, I don't think we're, well, you could be asking two questions, so maybe I'll try to answer both of them. We have a set of emergency authorities that are really at the core of why the Federal Reserve was created in the first place after the Panic of 1807 to backstop financial markets during a run on banks or a financial panic. And that's what we started doing in March and April. Dodd-Frank, which was passed, I think, in 2010, put some constraints on those powers and said we could only do those with the consent of the Treasury. And so we have done those very much with the approval of the Treasury, which is more the fiscal side of the house. In the CARES Act, Congress then passed some fiscal stimulus, including some backup loan programs, which it asked us to implement, which we've been implementing in accordance with the ask of Congress. And so that's, if you will, what we've been doing. And I don't think any of that is fiscal policy. That's monetary policy approved in the appropriate ways. I will say that when I took economics in college, we learned about monetary policy. We also learned about fiscal policy, and we learned that the economy responds better to downturns when they operate hand in hand. In this crisis, you could add public health policy to another one. If we weren't so worried about the virus, the economy would be much healthier. And so we've done a lot on our side. I talked about it. I'd say Congress has done a lot on their side. The CARES Act and the $3 trillion that were put into the economy back in the spring is quite historic, in its size and scope, and I think has had an impact, as I was, describing with some of the savings rate and personal income numbers I talked about earlier. And so, you will see people commenting on whether we should do more, but I think that's more talking about what would best support the economy as opposed to the Fed actually dabbling in it. Hopefully that's responsive to your question.
And next, the question of exchange rate dynamics and inflation rates across the world are unstable as well, given the pandemic, the COVID-19 pandemic. Can you give us some thoughts on how this could impact the U.S.?
Yeah, so obviously this pandemic has hit everywhere in the world, and some countries have handled it better than others, and those that handle it better have stronger economies. And when you have a stronger economy, that typically would lead your exchange rate to be somewhat stronger than an economy that's struggling with it. So that's the dynamic, I think, that you start with. When it then comes to inflation, we're relatively lucky in this country that international exchange rate dynamics have a very modest impact on inflation compared to countries that are overwhelmingly trading companies. Think the UK, for example. Inflation has a really big, exchange rates have a really big impact on inflation in the UK because so much of what they consume is imported. In the US, it's the same in China. I think our dependence on imports is more in the range of the high teens. And that's just not at all comparable to a country like the UK. So I think these exchange rate dynamics, they might have a modest impact if ours were to strengthen or weaken on the price of imports, but I don't think the price of imports has that big of an impact on inflation in the overall economy. You know, inflation in our economy, I still believe, is driven in part by the actions of the Fed. It's also, you know, influenced heavily by the dynamics of the economy, starting with people's expectations of inflation and what that means for price increases they'll give and price increases they'll take. You also see in our economy, price transparency has increased significantly with the rise of the internet, which means that consumers have more power over shopping and alternatives. I think that's probably limited inflation. You also see the rise of in B2B of purchasing protocols. I think at you know, merchandisers at home and garden stores or at Walmart who are able to negotiate aggressively and successfully with vendors. I think that's also kept prices down. And I think those have a much bigger impact for our economy than exchange rates.
And if none come in more, finally, we have approximately what percentage of U.S. consumer spending since the pandemic is from stimulus payments, such as the CARES Act, and what percentage do we see coming from actual, you know, personal income that's been earned?
Boy, I didn't realize I was going to get a math question. So the New York Fed published something yesterday that might be helpful. It took the stimulus payments and said, how were they used? And roughly, I think the numbers were 29% of those stimulus payments were put into spending. In other words, were, you know, put straight into the economy. And then roughly 35% and 36% were either put into saving, as I talked about earlier, or put into paying down debt. And so I think that's the best estimate I've seen of how those stimulus payments have been used. If I want to get to your question, I'm going to try to do this live. I've told you employment's down about 7%. So a simple way to think about that would be as off the entire personal income base. This isn't perfect, but you know, you could take 7% off, and that would describe the impact of fewer jobs. You could then, I told you personal income year to date is up about 3%. So you could say, all right, down 7, up 10. So 10% would be, you know, that stimulus. And then, you know, I told you out of that 10, that stimulus, a third went into spending. So, you know, I think you kind of end up net even, if that makes any sense.
And that is the end of the questions that appear in the Q&A.
Good. Well, again, I really appreciate being back here, John. Thank you for the invitation. I look forward to being back with you in person sometime soon.
Thank you so much, President Barkin. Those were great comments, and I really appreciate the questions as well. You know, fantastic to have that overview of the United States economy. So we're actually running a little bit early, but I'll go ahead and get started with my discussion of the West Virginia economy. Unfortunately, I actually have to start with an apology. Of course, my talk will be derived from the West Virginia Economic Outlook report that we produce every year. And I'm sorry to say that it's actually not posted online at the moment. I assure you it will be posted as soon as possible. It will be posted this morning, so you can kind of browse through the Economic Outlook report along with me. But we just were alerted to the fact that it's not available online yet, but it'll be up there soon. So I do have some slides that I'm going to use to support my talk. So I'll go ahead and get those up and running. Before I begin, let me just say really quickly that we really appreciate the generous support of our sponsors. This year, the event is sponsored by McKinley Carter Wealth Services, the Charleston Area Alliance, Omni Strategic Technologies, and McKinley Architecture and Engineering. And we also had additional support from the Chamber, as well as William McLaughlin. We appreciate their generous support. So on to my discussion of our state's economic outlook. So just to give you the big picture conclusion right up front here, it is very safe to say that we suffered the fastest economic collapse in modern history in the early part of this year. The severity of the recession that we saw and the speed at which that recession came on especially was just unprecedented. But as far as I'm concerned, the recovery so far has been stronger than I expected. I mean, it's not for sure whether, any individual person is going to be a glass half full or a glass half empty person. But when I go back to March and April, when our economy was really in free fall, I must say that I would not have expected the recovery to have come along this far by October. So overall, I'm kind of a glass half full person as far as this goes. And I think that we have seen a fairly strong recovery, or an unexpectedly strong recovery thus far. But we are already seeing, and we expect this to continue, that the remaining ground that we have to cover to get back to where we were at the beginning of this year, the recovery is getting slower and slower. The first few months of the recovery were really rapid, really healthy, but it's slowing, every month that we move along. So we don't expect full employment recovery until sometime in 2022. It's going to take roughly a year and a half before we completely get back to the level of employment in West Virginia that we saw at the beginning of this year. And that said, the level of uncertainty surrounding our economy was truly unprecedented earlier this year. We've never seen this much uncertainty before. And, even though I'm going to be giving you economic, forecast numbers, the fact of the matter is we still face a lot of uncertainty. So everything this year kind of comes with a caveat that there's always some economic uncertainty, of course, but this year the level of uncertainty is ratcheted up several notches. And I'm going to kind of close with a reminder that, this year our focus is on getting through this pandemic and getting back to normal, but we still have a lot of long-term challenges in West Virginia that have not disappeared because of this pandemic, and that aren't going anywhere anytime soon. So even though our immediate focus is on getting back to normal, we still have those long-term challenges that we should still be pushing forward on to improve our economy over the long run. So first key to understanding our state is just the facts related to what's happened during this COVID pandemic. How hard has our economy been hit, and how much of a recovery have we seen so far? So first and foremost, here's the overall big picture employment number for West Virginia. And oh boy, what a graph. Overall, our state lost 94,000 jobs. If you look back to around the 1st of March or so, if you compare the employment number then compared to what we saw when we really hit bottom there at the end of April, the first part of May, overall we were down 94,000 jobs. That takes us, this graph doesn't go back that far, but that takes us back to the level of employment that we saw somewhere in the early 1990s. Overall, that was a 13% job loss. 13% of all the jobs in West Virginia were lost over a 2-month period. Now, I will say we've seen job loss of that magnitude before a couple times. In the early 80s, the economy in West Virginia really suffered. And of course, it goes without saying, in the Great Depression in the 1930s, our economy really suffered. So 13% job loss, that part isn't unprecedented. But the fact that it happened over 2 months is absolutely unprecedented. The Great Depression, for example, the Great Depression took about 3 years for the economy to really hit bottom, as all of those events unfolded. 2 months, completely unprecedented. But on the positive side, our economy has already gained back 57,000 jobs. You see the jump there that has occurred over the past few months. The jump that has occurred since May, gained back 57,000 jobs. And I think a lot of people see that number, and a lot of people think, wow, that's actually faster than I imagined. So down 94,000, back up 57,000 so far. If you just do the simple math there, currently we are down about 37,000 jobs compared to where we were at the beginning of the year. Now this figure shows you our loss in employment compared to the losses experienced in neighboring states and in the nation as a whole. The blue lines, the blue bars show you the losses that we suffered from mid-February to mid-April. And then the yellow bars show you the gains back that we have experienced from mid-April through mid-August. We lost 13% of all of our jobs in West Virginia. Now, here's something I thought that I would never say. I thought I would never say this. The 13% job loss that we experienced, well, it could have been worse. Nationally, job loss was 14%. Maryland lost 14%. And you see our neighboring states of Ohio, Kentucky, Pennsylvania suffered even worse job loss. So 13% sounds bad. It is bad, but believe me, it could have been worse, and it was worse in most of our neighboring states. And then likewise, you see the yellow bars showing the growth back that we've experienced since the 1st of May or thereabouts. We've gained back 9% of our jobs since during this recovery period, and that 9% is looking pretty good. So on both sides, West Virginia has done better than most of our comparison groups, and I'm pretty excited about that. I'll move on to show you how unemployment has moved during this crisis. The blue line there shows you the West Virginia unemployment rate, of course, compared to the nation in the gold line. Our unemployment rate was just under 5% when this recession started. We started out at about 4.9% in West Virginia. The rate skyrocketed up to about 16%. Again, over a 2-month period, we suffered an 11 percentage point increase in unemployment, but we've already improved back down to 8.9%. So from about 5 up to about 16, down to about 9. So I'm telling you, if you'd come to me when unemployment was 16%, if you'd said that we would be slightly below 9% by the middle of October, I'd say, wow, I'm kind of surprised that we've experienced that quick of a recovery. But that's where we are. It's recovered fairly quickly so far. But the path that we've seen has been similar to the nation. You can see the underlying gold line there. And that trajectory has been similar to what we've seen nationwide. This figure is the exact same parallel to the one that I had 2 slides before. The yellow bars show you, or excuse me, the blue bars show you the rise in the unemployment rate that we saw, and then the yellow bars show you the improvement back that we've seen since the 1st of May or thereabouts. And it's the same story. The story here is just the same as before. That 11 percentage point jump in unemployment that West Virginia suffered was not as bad as the nation, and it wasn't as bad as most of the neighboring states. And the 7 percentage point improvement back that we've seen has been pretty strong as well. So again, just like with employment, the unemployment situation could have been worse, and it was worse in most of our comparison groups. This figure shows you the job losses by sector. The blue bars show you how many jobs were lost in total and for each industrial supersector over the period of decline. And then the yellow bars show you the growth in the number of jobs for each supersector since the middle of since the 1st of May, since we've been growing again. It's no surprise leisure and hospitality suffered the biggest job loss. Leisure and hospitality, that's where we have all these restaurants, all these bars that were closed. So no surprise of the magnitude of the job loss there. Trade lost almost 13,000 jobs in West Virginia. That's, a lot of the retail is included in the trade sector. So all of the retail establishments that were closed during the lockdown, that's where those job losses appear. The 3rd hardest hit sector was actually education and health services. That's our health sector actually suffered the 3rd biggest job loss. That's somewhat counterintuitive because, of course, some parts of the health sector were booming with COVID patients, of course, but you have to remember that health sector also includes a lot of those elective procedures that were shut down. And it includes things like, the eye doctor, the dentist, all those kind of elective things that were shut down. Anyway, altogether, every sector in the state suffered, and you can see how those losses stack up across the different sector. And almost every sector has added back jobs during the recovery period. Manufacturing actually is the only sector that has fully recovered. You see there 2.5 thousand jobs lost, 2.5 thousand jobs gained. So manufacturing has fully recovered, at the very least, in terms of, if you're rounding at that level, it has fully recovered, but it's the only sector to have done so. One more figure to just lay out the magnitude of the shock that we suffered. Here's the unemployment insurance claims that we've in West Virginia. The figure started out at about 17,000, the first of the year before the crisis hit, and the figure absolutely skyrocketed from 17,000 up to about 146,000 by the time we got to the middle of April. Go from 17,000 people who are on unemployment insurance up to 146,000 over the course of 2 months. But the figure, as you see, has steadily improved since then. And for the latest reading, the figure's down to about 38,000. So lots and lots of good improvement in that unemployment insurance benefits figure. But you know, I'll still note we're still about double where we were to begin with. The figure still stands at about double where we were on January 1st or March 1st or whenever, but it has shown marked improvement, and I'm pretty excited about that level of improvement. And I just want to mention, you know, even though our economy and even though, you know, people have been stalled to a large extent, and even though we kind of feel like we're stuck until we get through this crisis, I will say that's not entirely true. There are some good things that are happening in West Virginia. I will say the development office is still plowing ahead and creating you know, new jobs for the state and creating new agreements. I just will say, just based on agreements that the development office has negotiated this year, they've created 400 new jobs through their agreements, and they've engineered additional agreements that have retained 1,500 jobs altogether. And there are a couple of examples of new jobs they have created. These particular examples are in Ohio and Berkeley counties. So we're still moving ahead with developing our economy, even despite this crisis and the way that it has us all felt, feeling like we're kind of stuck in the mud or whatever. So that's what's happened to the economy big picture. Let me move on to talk about the energy sector. As you know, before, I always claim it's impossible to understand West Virginia's economy without understanding what's happening in energy. You know, here's the picture that shows you, here's the picture that's worth 1,000 words, showing you what's happened to coal and what's happened to natural gas over the course of the past several years. I'll just remind you, coal production was at 158 million tons at the last high that you see there. It fell down to about 80 million tons in 2016. Coal production bounced back to the mid 90 million ton range in more recent years. But during this year, coal has suffered greatly, and coal has fallen down to about 60 million tons. So coal now stands at, you know, about 20 million tons less than the bottom that we saw in 2016. Overall production has fallen by about 30 million tons this year. It's been a real substantial hit to coal this year. We do expect some bounce back in coming years, but we don't expect coal to to get back to what we thought was normal here a few years ago. Natural gas as well is suffering during this crisis, but we expect the downturn in natural gas to be fairly short-lived, and we expect to get back to steady growth there here pretty soon. With coal, I just want to show you what's happened with coal. These bars show total coal production in West Virginia each year. The blue bars show the portion of coal production that goes to electric power generation. The yellow portion shows the part of coal production that goes to exports. Of course, over the long run, all the drop has occurred in electric power generation, or the big driver of the drop has been in electric power generation. But if you look at more recent years, the fluctuations have occurred in exports. And that's 2020 isn't shown, but that's what's really driving the fluctuations this year as well, is exports. So the improvement that we expect in coming years will come through export markets, not through domestic markets. But export markets are more volatile. You can see that volatility reflected here. And you know, we're exposed to more volatility now because coal is more dependent on export markets, and they're inherently more volatile. This figure shows you just how the coal market nationally has evolved in recent years. This shows you the share of electric power generation that comes from coal, natural gas, and from renewables. And you can see that big evolution there where natural gas has risen substantially, coal has declined substantially, and renewables have also risen in an important way. So there's that national evolution. If you look at the regional coal production in West Virginia, as many of you know already, the big decline that we experienced in recent years came from our southern coal fields. Nowadays, northern production and southern production is almost exactly the same, and the two coal basins have moved in similar ways over the past few years. So a very different dynamic there compared to what we were accustomed to, several years back. Turning over to natural gas, a big driver of natural gas output growth in West Virginia has been improving pipeline capacity. This shows you overall outflow pipeline capacity in West Virginia over the past several years. You can see the big growth that occurred there from 2012 through 2019, but that growth is tapering off now. Several of the major pipeline projects that were in place over the past couple of years have been finished, just naturally, they're just finished now. And a couple of the other pipeline projects have been canceled due to various considerations. So we've seen big growth that has boosted construction in West Virginia and has given us an economic boost during that construction phase. But now that's tapering off, and we don't expect that to be a big driver tapering off. And one more thing about natural gas, the blue bar shows you the number of rigs that are drilling new wells in the Appalachian region. We don't have this for West Virginia specifically. This is for the broader region here, but the blue line shows you the number of wells that are being drilled, the number of rigs, and then the yellow line shows you the production per new well. And you can see it's important to notice that the number of new rigs is down substantially. It has fallen considerably this year. And so we're not drilling nearly as many new wells as we were even 1 year ago. But by the same token, the new rigs that are being put in place are far, far, far more productive than they were in recent years. So there's some trade-off there in terms of not nearly as many rigs, but each rig that's in place is far more productive. So now that I've gone through the shock of COVID, now that I've gone through energy and how energy markets have been driving our state economy, I'll come back to one long run issue before I move on to our forecast. I want to mention this issue that has been a major economic development impediment for West Virginia for quite some time, and it continues to be an economic development impediment. And I don't want to forget about this issue right now, because we're focusing primarily on the short run and on COVID. We've talked about the unemployment rate. Right? We've seen how unemployment rate has moved. We see that the unemployment rate is now below 9%. That's a good thing in comparison to where we have been. But remember, unemployment captures among everyone who wants to work, how many people have a job versus how many people are looking for a job. But I always stress this other labor market characterization, the labor force participation rate. Labor force participation captures among your entire adult population, how many people want to work in the first place. Don't even worry about whether they have a job today or whether they're just looking for work. But how many people want to work in the first place? The figure's 63%. West Virginia, we're dead last at 55%. In West Virginia, only 55% of the adults want to work. Whether they have a job or not, only 55% of the adults want to have a job. We're 8 percentage points below the nation. If you remember my previous talks, that's actually an improvement. Last year, when I was giving this same talk, I noted that we were 9 percentage points below the nation. So we've actually improved by 1 percentage point, although that's rounded, so the improvement wasn't a full point. It's a rounding issue to some extent. But listen to this. Once we get through COVID, once we get back to normal, the fact remains that we're never going to be where we want to be. We're never going to experience the economic prosperity that we want to experience unless we get more of our people in the workforce, right? Even when full recovery from COVID has happened, we still have to remember to push on this issue. We're never going to experience the prosperity that we hope for until we get more of our people in the workforce. And there are three reasons for this deficit, at least three reasons. One is education and training. We have a lot of people in West Virginia who just don't have the education and training that they need to get hired, so they don't look for work in the first place. We have to continue to push on improving the workforce preparedness of our people in terms of education and training. That will get more of our people in the workforce. That will create more opportunities for West Virginia in the long run. Another issue that's driving this deficit that we see, this 8 percentage point deficit, is health. We have a lot of people in West Virginia who would like to work in a perfect world, but they know they can't really hold down a job because of health concerns. So they're just out of the labor force altogether. They're not even looking for work. We have to continue to work on improving our health outcomes to get more of our people in the labor force to make our state more attractive to potential businesses in the long run. And the third issue is drug abuse. As an opioid epidemic in recent years. I'm sorry, I got distracted there for 1 second. We've really felt the brunt of the opioid epidemic in recent years. And we have a lot of people in West Virginia who would like to work in a perfect world. They've managed to get caught up in this cycle of drug abuse, and that's preventing them from looking for work. We have to continue to fight this drug abuse problem. I don't have data for 2020, but of course, as many of y'all have read, drug abuse has gotten more severe during this pandemic as people are, stuck at home and they're disappointed, and sometimes that naturally gives rise to drug abuse. So anyway, I don't want to go on about this point forever, but my point is, even when recovery happens, we have to remember this. We have to remember the human capital issue. We have to remember the importance of making our state more attractive to potential businesses by being able to provide potential businesses that might move to West Virginia or start up in West Virginia, by providing those businesses with a stronger, healthier, drug-free, better skilled workforce. So let me present our economic forecast. I just want to mention that, economic forecasting is always difficult, right? The economy is so complex, right? We have so many different pieces moving within our economy. It's just by its very nature, economic forecasting is a very difficult business. And I will say that that's only multiplied substantially during this crisis. I mean, here's the real fundamental problem with forecasting right now, in addition to the normal difficulties of forecasting. Normally when we have a recession, the recession occurs because of some problem in the economy. Some problem in the economy arises, that puts us in recession. Economists have to study that problem and, come to an understanding how long it's going to take for that. Back on March 1st, our economy was just fine. We had no economic problems. I mean, there were some economic problems. I'm not saying it was perfect, but all of the kind of the short-term, big picture macroeconomic indicators were just fine. This recession came out of left field as a result of a public health crisis, not because of an economic crisis, not because of economic matters. So here we are trying to forecast an economic recovery where the recovery itself is largely dependent on public health matters, not dependent on economics matters. So we really have our work cut out for us, is my point here. Now this figure is just a stylized diagram. This doesn't show real data, just so bear with me for just a second. I'll show real data in just a minute here. But I just want you to understand the ways in which people think about recoveries. So the blue line is what we refer to as a V-shaped recovery. I think it's pretty straightforward where we get the term V from. It looks like a V. And a V-shaped recovery is a recovery where we fell into recession pretty quickly, but then we recovered pretty quickly, got back to normal pretty quickly, and then just moved on. So a V-shaped recovery is what we hope for, right? Once we saw that the recession had occurred, everyone was hoping for a V-shaped recovery. Now, a W-shaped recovery is when the economy starts to recover, but then an additional shock happens. The economy falls right back into recession again. Economy kind of falls into a second recession before the first recession even disappeared. W-shaped recovery. We don't want a W-shaped recovery. I don't specifically foresee a W-shaped recovery, but it's a possibility. Next option is what a lot of people lately have been referring to as a Nike swoosh shaped recovery. What we have here looks more like a check mark. I think our graphic design wasn't 100% on top of it here, but people refer to this in the media as a Nike swoosh shaped recovery. And so that kind of recovery is a quick drop, but a slow, gradual improvement. And then the last option is an L-shaped recovery. And an L-shaped recovery is a misnomer because an L-shaped recovery isn't a recovery at all. It's when you fall into a recession and then you just move forward horizontally from that low point of the recession. So I will say this, we are calling for a V-shaped recovery. Our forecast overall is pretty optimistic, I think. And the fact that we've already added back 57,000 of the jobs that were lost in West Virginia, that already rules out an L-shaped recovery. So the real kind of pessimists back in March and April, the real naysayers who were calling for an L-shaped recovery, I think they've already been proven wrong. And I think to a large extent that applies to the people who were kind of expecting a swoosh-shaped recovery as well. Anyway, the bottom line is, so far, we're calling for a V-shaped recovery. Now, it's not going to be a perfect V, but it's going to be a V that experiences rapid improvement, but then kind of tapers off a little bit. So it's going to be a V with a little bit of a movement to the right, you know, on the upper right-hand side of the V. So it won't be a perfect V, but we're calling for a V-shaped recovery. And another part of this is where, you know, as we look through economic indicators, we look for signs of lasting damage to the economy. We're looking for things that are bigger picture or longer lasting than the direct results of the shutdown of the pandemic. We're looking for things like permanent bankruptcies or permanent layoffs. And for the most part, we haven't seen a whole lot of that. For the most part, we've seen you know, signs that this is a temporary recovery. We haven't seen a lot of signs of permanent damage. So that's even more of a reason why we would talk about a V-shaped recovery. So here is our actual forecast. The line shows you what we think is going to happen. And then we also have a couple of additional scenarios based on how national economists think about how different characterizations of the national economy can unfold based on the pandemic and how the pandemic can unfold. We have pessimistic scenario and an optimistic scenario based on what we believe are kind of the bounds of reasonable assumptions associated with the recovery nationally. And of course, we've tailored that to West Virginia. But overall, you see, our headline conclusion is we're going to get back to where we were by sometime in 2022. You already see the growth that we've experienced. We think that growth is going to continue, but be a little bit slower through 2021, and we'll get back to where we were at the beginning of this year by 2022. If the optimistic scenario unfolds, well, it'll happen quicker. We'll get back to where we were at some point in 2021, rather than an additional year down the road. And of course, you see the pessimistic scenario there as well. I'm not going to focus on that because that speaks for itself. But overall, we think if you give us another year and a half, we'll be back to where we were. But if things turn out to be more optimistic, then it could be quicker than that. But I do want to mention once we do experience that full recovery, overall, we're really expecting some weakness for the West Virginia economy in the later part of the outlook period. With the slowdown in pipeline construction and natural gas production growth, and with some other long-term challenges in the economy, we think the latter part of the outlook period will be weaker. So, so that's why, even though we're focused on this short-term improvement, we still need to remember those long-term challenges, because it does get weaker as we go on down the road there. And I do want to note as well, if you notice, state lost jobs in 2019. You can just look over the previous year there of the blue line before we get to the forecast, and you can see 2019 wasn't a great year for the state, as we lost jobs when we were at the beginning of this year. That's still below where we were at the beginning of last year, with those pipeline construction jobs ending or disappearing. Here's the unemployment rate forecast. It is kind of a similar story. It's going to take a little bit longer for unemployment to recover. That sounds a little bit weird, but the unemployment dynamics are a little bit different than the employment dynamics. So we're not going to get to a recovery in the unemployment rate until about 2023, although it could happen by the beginning of 2022 if the optimistic scenario ultimately unfolds. But overall, the story is the same here. We expect continued improvement, but the improvement will be more gradual as we move forward. And now this figure is my last forecast figure, but this shows you the baseline growth that we expect is reflected in the gold line. But this is over a 3-year period. This is over from the beginning of this year through 3 years in the future. So it shows you the baseline growth that we expect, but then the growth that we expect by sector under the optimistic and under the pessimistic scenarios. So overall, we expect growth in total employment over the 3-year window, as you can see by the gold bar right here. So we do expect overall growth over the 3-year window, and we expect growth in the big sectors like manufacturing, health, natural resources, and mining. But even over the 3-year window, we expect retail and leisure and hospitality to suffer kind of long-term damage, and government's down there as well too, but I won't focus on that part. But that's part of what's weighing down the economy, because of the fact that we're expecting kind of long-term lasting damage in retail and leisure and hospitality. So that's kind of masking in some sense the growth that we expect in other parts of the economy. Even under the optimistic scenario, more pessimistic assumptions that are still within the realm of reason, it's possible that retail and leisure and hospitality can still be significantly down by the end of this 3-year window. So that sector is really, kind of placing a weight or a limit on the economy overall in the long run. I'm almost out of time here, but I just want to show you just really quickly how economic outcomes have varied region by region. Here I'm just showing you how the unemployment rate has varied across the state. And I'm showing you the unemployment rate when the crisis was the worst back in April, and the unemployment rate when the crisis was kind of the most recent data as the crisis was improving. The southern coal fields, we have it in the dark red because there the unemployment rate has kind of been the most severe within the state. New River Gorge area also suffered severely when the crisis was at its peak, but now the New River Gorge area has improved a little bit better. So the New River Gorge has moved from dark red to kind of light red or pink as the region has improved. The Metro Valley was hit pretty hard when the crisis came on in the spring, but the Metro Valley has actually come back to be a little bit better than the overall statewide average as the economy has improved. So the Metro Valley has actually moved from dark red to light blue over the period. North Central has been one of the strongest parts of the state throughout the crisis. Obviously unemployment jumped substantially in North Central as well, but compared to the overall state average, North Central consistently looked better. The same is true for the Eastern Panhandle. It has consistently been one of the stronger regions as well, at least in terms of unemployment during this crisis. The shale gas boom region has been a little bit worse than average as far as the state goes in terms of the suffering that it has experienced during the crisis. And the Mid-Ohio Valley region suffered pretty substantially, but it has shown some improvement compared to the state average. So it's kind of changed categories over the period. With this region by region analysis, I just want to make the point that kind of the long-term patterns that we see when we look at the state region by region, those patterns have pretty much persisted during this crisis. The regions that have the more diversified economies, the regions that have the more attractive human capital outcomes have been the regions that have shown more resilience during this crisis, and the regions that have the more underlying problems have shown a greater level of suffering during this crisis. So I am out of time there, so I'll stop there. Unfortunately, I don't have time for questions. If we have time later, maybe I can come back on and address some additional questions, but that is kind of where we stand in the economy, and that is their forecast for how improvement is going to continue over the next couple of years. Thank you all so much, and now I'll turn it over to Mark Mukow to discuss the revenue situation here in our state. Mark, are you there?
I'm here.
All right.
And let me see if I can get my screen working here.
Yep. And your mic, everyone wants to see you now. You're a handsome guy, and we want to make sure that your mic's on, or your camera's on.
Let's see, camera. I'm not sure if my camera's on, but let's see. How do I get the camera? Let's see. I'm not sure about the camera, but
well, don't worry about the camera then.
I'll just go with my presentation.
Yeah, sounds good.
In the fiscal outlook, I'm going to present the where we were before the COVID crisis hit, the impact of the COVID crisis, that two or 3 month recession, and then the recovery, along with how we balanced our budget during this situation. And I'm advancing. Hopefully, the screen is advancing. Let me know if it's not.
No, we don't see your screen yet.
Let me see.
Share at the bottom.
Let's see. How do I share?
Well, you had it down earlier at 8 o'clock.
Yeah, let me see if I can find a way to share.
Remember, there should be that green icon.
I can't seem to get that up. I'll just talk then, because I can't seem to figure this out. Let me see here. Hold on a second.
Well, let us know if you want us to move you in the program. We can go ahead and go to the panel discussion if you wish.
Yeah, for some reason, none of that's popping up on me. I can't seem to, maybe move me if I can.
Okay. I don't know what happened because you had it working at 8 o'clock, but okay. David McKinley, are you there? Do you want to go ahead and proceed with the first segment of the panel? We'll come back.
I'm happy to go ahead. Let me just check and make sure. I saw Danny Twilley, and I think I saw Mike Green. Is Greg Correa with us this morning as well?
He is with us.
Excellent. All right. Well, let's get started. And what we'll do, I'd like to just provide a little bit of background. Just, I think earlier in the session, John talked a little bit about the purposes of these events. Of course, we're trying to bring together valuable resources. Of course, we started our day with the national and global outlook, and we heard from from John, and we'll hear from Mark around the status of what's happening in West Virginia. But ultimately, we want to talk a little bit about how this is affecting our state, and we want to kind of build on that background. Do we have a headwind or a tailwind, and what is the outlook up here? And how do we make investments? How do we make decisions in our businesses and in our government roles? How do we set ourselves up for success in the future? And as I think back over recent years, we've talked about a variety of themes. Things like, for example, the importance of natural gas and coal to our economy. We talked about why our region is so attractive for multi-billion-dollar investments in ethane cracker plants. We talked about the importance of the downstream manufacturing opportunities. How do we bring back to life the plastics industry and so many others throughout our state? But along the way, a theme that we've talked about, and John hinted to it again, was around workforce participation. You know, how do we overcome these challenges in West Virginia? And the last couple of years, that's been a focus. So last year, if you participated, we talked about strategies for retaining and educating our young people. We heard from Sarah Armstrong Tucker, the head of the Higher Education Policy Commission, all the various programs that the community colleges and four-year programs are available throughout the state, and some pretty specific to prepare people for specific jobs. We also talked about, last year, we also talked about helping people with addiction overcome their challenges and return to the workforce, and there are lots and lots of resources available. This year, we're taking a slightly different tack, and frankly, those that we've talked all morning so far about COVID-19. It's shown up in many, many ways. And I think it's important that I think it's clear to all of us, there are going to be long-lasting impacts in the world, in the United States, and of course in West Virginia. And what's interesting is that West Virginia, we've joked at the beginning of COVID-19, we've been socially distancing since 1863, but the reality is that's true, is that we do offer that opportunity, and we have a wealth of outdoor recreation opportunities, things that would make our state very attractive, particularly to a millennial generation and those of others with outdoor interests. Of course, some of the challenges to that are broadband access, higher education for children. There are a variety of things, and today we're going to talk a little bit about some of those. How do we leverage those natural advantages, and how do we continue to invest in ways to create environments that would be attractive, that could bring remote workers that have the choice of working anywhere in the world, anywhere in the country, to choose West Virginia, whether they have a West Virginia connection or not. So with that, this morning we're going to talk to three speakers, excuse me. The first section will be with Danny Twilley and Greg Corio, and the two of them, I'll just kind of generally introduce what their effort is. They both are with WVU, and they're associated with the Outdoor Recreation Program. Greg, I think, from like last 15 years or so, has been building a program, bringing the outdoor recreation opportunities to WVU students and helping them connect with West Virginia in a special way. And along the way, statistics bear out that they actually have a higher retention and graduation rate. So thank you, Greg. Danny Twilley has joined the team there a little more recently and is part of advancing a new initiative to, in fact, attract remote workers to West Virginia, building programs to make West Virginia attractive. So without any further ado, because they have lots to share this morning, I want to give them as much time as possible. I hand the mic, so to speak, to Greg and Danny.
Thank you, David. Thanks, John, and good morning, everyone. I've been at the university about 16 years and had the pleasure to work in the state. I grew up in Taylor County, and our office, as Danny brings our screen up, our office is about 9 months old, but I've been at the university 16 years, and every dollar WVU invests in our outdoor orientation program returns $10.60 back to the institution. But during those 16 years, I've seen the power of showing off our state of West Virginia. And at the same time, there are all these national trends. So today we're going to talk about what's happening nationally, some of our assets in West Virginia and our competitive advantage, and then what we're doing with the shift in society around COVID and remote workers. But as I've been working here at the university, there are these national trends that kept coming out. And it really started in 2017 that really opened my eyes to the power of the outdoor economy. The Outdoor Industry Association looked at the entire outdoor industry. That's hunting, fishing, biking, skateboarding, ski resorts, all of that. It's an $887 billion industry. When you dive into that, that's as large as pharmaceuticals and motor vehicles and parts combined. It is a huge segment of our industry. And so report after report are coming out about how big this sector is. And can we go on to the next slide, Danny? When we look at the offices, so starting in 2013, Utah was the first state that created an Office of Outdoor Recreation, followed by Colorado and Washington in 2015, because the states realized how big their outdoor industries were and that they were attracting businesses to come there. When you look at the U.S. Bureau of Economic Analysis report, from 2012 to 2017, nationwide, the outdoor economy grew at 16.6%. When you look at Colorado, they grew at 30%. Utah grew at 29%. You can see the states around West Virginia. Ohio grew at 10, Kentucky 13, Virginia 16, Maryland 15, PA 16. West Virginia grew at 1%. So we only outdid Louisiana. Kansas grew twice our rate. But what we're going to talk about today with our assets is we can win in this space. We just need to turn on and leverage these assets in the right way. And so when you look at these reports, I was out in Utah in September and met with the director of the Governor's Office of Outdoor Recreation in Utah. University of Utah is interested in modeling our adventure program at WVU. The Utah Outdoor Partners, they basically studied the tech businesses from Ogden to Provo, and they call that area the Silicon Slope. And this was one of the first articles that really turned President Gee's head as I was trying to create this new office at WVU. And when they looked at the tech firms, many of these are not outdoor recreation firms, how did outdoor recreation fit in their decision to move those businesses there? The second reason was that the CEO wanted to be in a place for quality of life, access to skiing, biking, the natural landscape. The number one reason was being able to attract employees, and they could steal people from Silicon Valley to move to Salt Lake City area, the Silicon Slope, because of quality of life and outdoor recreation. So there's something happening there. And I will say that they've got water issues. They don't have enough water right now, and they have air pollution issues. They expect their population to double in the next 30 years.
You also have other places closer to on the east side, eastern United States, like Roanoke. Roanoke's really trying to make this connection between outdoor recreation and quality of life and business and economic development. For instance, the Roanoke Outside Foundation is starting to make this connection of where trail meets trade and how to locate your business here. When you dive down a little bit further on that website, they have a whole video that shows someone leaving their house via a bike and going to all the great amenities that Roanoke has to offer, from their arts to public spaces, their downtown. And so it's really starting to focus on this quality of life. Duluth has been, transformed itself as well after the manufacturing, auto manufacturing really left in the late 80s. They started to really think about how do they become a vibrant community through outdoor recreation, and they've done a fabulous job there. One of the more recent kind of stars in this space has been Bentonville. One of the things that they were struggling with as they were really growing was to attract and retain talent in order to grow, Walmart, as they decided to keep their headquarters in Northwest Arkansas. So they were trying to get people from Houston, San Francisco, New York, and Chicago to come here and help them grow that business, but they wouldn't stay. So, fast forward, they invested in art, food, culture, this quality of life. And then they started really making the strategic investment in trails, because they didn't have the climbing, they didn't have the whitewater, but they had the ability to create high quality trails. And right now they're competing with many of the great, outdoor communities in the US, in Colorado and Utah and California and Washington because of that. And so fast forward, they're considered one of the top 5 best places to live. And this past year, they're ranked one of the fastest growing areas. And they're able to attract and retain people even outside of the Walmart kind of bubble and circle as a result of this quality of life that they're creating in Northwest Arkansas. So, we go back to understanding where population growth is in West Virginia, and we start taking a look at what's happened in Colorado and in Utah, and their population, they're number 1 and number 3 in population growth from 2012 to 17. And so let's take a look at, that's kind of that correlation. But, we can make a little bit of assumptions here. So the generation born between 1980 and 2000 is outspending Generation Xers and baby boomers on things like travel, activities, and sports. Why that's important is because that generation is typically, 1980 to 2000 is, finishing college, young in their families, young in their careers, maybe going back for an advanced degree. So they typically don't have a lot of time or a lot of disposable income, where Generation Xers are late career. They probably maybe have empty nest, so they have a little bit more time. They have more disposable income, where baby boomers have time and money. They're being outspent by those without the time and potentially without that money on things like travel, activities, and sports. You couple that with this idea that people are moving to these Western cities in pursuit of an experience-driven lifestyle, that's showing a value shift. Something's happening in what's important to young people and how they value. They start thinking about, where do I want to live first, work second, and how do we capitalize on that?
So one of the things our office has been doing is looking at outdoor recreation, and in this space, in the outdoor recreational space, we gave this presentation to John Chambers, and he threw his hands up, touchdown. This is our sustainable economic advantage. We have assets that you can't easily replicate that give us a competitive advantage compared to the states around us. We have flat water. All the states, most of the states in the United States have flat water, but they don't have white water. So when we look at rock climbing is a $12.4 billion annual business in the United States. I worked with a student last fall, and she looked at all the rock climbing gyms in the major cities. If they travel, they all come to West Virginia. We can dominate in the rock climbing space on the East Coast. We have some of the best, if not the best, rock climbing in the Eastern United States. When we look at whitewater, we are getting ready to publish this map nationally. This is the greatest density of whitewater in the country. This is every whitewater put in the United States, geospatially shown. This is a map of the US in the upper right. We are sitting on the greatest whitewater in the country. Huge differentiator for West Virginia. And then we're actually doing research as the West is getting drier. Unfortunately, a lot of people are really suffering. We're actually getting wetter. Our streams are running. We are water rich as a state. So we're looking at the total number of runnable days. We're doing a 10-year analysis on the total number of runnable days per river. So when you look at the Cheat River in Preston County, it runs 76% of the year, basically 280 days a year. The New River, 100% of the year. You can kayak there 100% of the year. So when you start overlaying, you see these maps on the bottom left, and we look at these towns that are thriving. Asheville, North Carolina is booming. It took about a 20-year process to get there, but people are moving there in droves, and young people for that experience-driven lifestyle. But their assets are not nearly what we have in West Virginia. Within a 10-mile radius of downtown Asheville, they don't have any rock climbs. Fayetteville has 2,500 climbs. When we look at whitewater, so within an hour-and-a-half drive of Boise, Idaho, which is known as a whitewater town, they have 98 miles of whitewater. Within an hour-and-a-half drive of Boulder, Colorado, one of the top outdoor cities, they have 122 miles. Morgantown has 605 miles, Beckley 820 miles, Elkins 875 miles, and Thomas Davis 1,103 miles. The researcher doesn't think he can find another outdoor town in the United States that has access to more whitewater runs than Thomas and Davis. And so we're excited to get that story out. And this is a space, again, that we can win in this area.
So report after report is coming out that's talking about the economic impact that outdoor recreation is having. So one of the things we started looking at is, from the US, we're 45th in terms of jobs that are directly related to outdoor recreation. And again, we're 49th in that growth period that Greg mentioned earlier. But what I wanted to do is take a look at some of, looking at the Monongahela, the New River Gorge, and some of the public lands out of Morgantown. And we have about 1.1 million acres. When you start taking a look at other reports that came out, and when you look at rock climbing, mountain biking, and commercial and non-commercial paddling in Western North Carolina, which is about 1 million acres, they saw $83 million in visitor spending, additional $30 million from Western North Carolina residents, and it equated to about 1,000 full-time jobs. just over 1,000. In Colorado, they did the same study, but they added hiking into it, and hiking added an additional $24 million in visitor spending. In addition, I think it was important to recognize is that, it's almost double the amount of acres, almost triple the amount of acreage out in Colorado, but it's still the economic value and the jobs created were much higher in Western North Carolina because it has access to population centers. And so we have the ability to compete with Western North Carolina in this space. So what is our office kind of doing? And so our office, again, we're 10 months old. And one of the areas in which we're focusing on is this idea of asset development and mapping. So you saw a lot of that outcome. We're working through all the different communities or various communities in West Virginia to kind of continue to tell this narrative and story about what type of assets they have. We're comparing them to what we would call other iconic destinations like Asheville, Chattanooga, Boulder, Bend, Oregon. So we're, again, trying to see where we compete and where our strategic advantage is, because we have something that's valuable, rare, and hard to imitate in our outdoor recreation. And other communities have been able to leverage this. On top of that, we're also trying to figure out how do we enhance it. Those other communities have done strategic investments into their infrastructure. For instance, Utah has a fund for $5 million in which every year they distribute to support outdoor recreation asset development. And so in order to compete in this space, we have to start thinking about how do we build off this great canvas that we have here in the state.
One of the things that we've been looking at with the shift in society, and David kind of mentioned it early on, that pre-COVID, they were estimating that 25% of tech workers from Silicon Valley were remote workers, could live anywhere they wanted in the country or potentially the world. And post-COVID, they're expecting 50% will become remote workers permanently as COVID has been such a big disruptor in the United States. So as Danny and I were thinking about what do we have that's rare, we have these folks that there's a growth of the outdoor economy across the United States. People are moving to places for that experience-driven lifestyle. We have unique assets. And so can we leverage those unique assets to bring people here to West Virginia? But what's really important to know, so we are developing a remote worker program, but what we're doing that's different when we look at some of the other programs that are out there, I mentioned earlier that we have the largest outdoor orientation program at WVU, and every dollar WVU invests returns $10.60 because the students retain and all the way through increased graduation rates. It is so important to create a sense of community. We want to change our trends from losing our population so we can keep our young people in the state of West Virginia and recruit other people to move to West Virginia to increase our tax base. But we're spending a lot of time creating a sense of community and belongingness and showing people the amazing quality of life you can have by living here in West Virginia. So we have been we're looking at national models on insights and lessons learned and kind of benchmarking when we designed our program.
So, we're building it around this idea of community, purpose, and outdoors, right? And we want to create this vibrancy around where you can live, work, and play. And some of the things that we're looking at, we're doing a 2-year program. There will be a financial incentive associated with that. We're doing a welcome trip to show them the beauty. So once they get here, we're going to get the members involved, and we're going to connect them to each other and to our state. We're planning, unique social events. So every, week, every other week, they'll be coming together for an outdoor outing. We'll have guest speakers. We'll be able to, help them get to Banff Mountain Film Festival and things like that in order to, again, to connect them to each other and members of our community. We're going to provide them with access to equipment. So again, hey, Greg, I know you like to climb. I've been wanting to climb, and now it's right out my back door. Hey, can you take me? And Greg says, yeah, go grab some equipment, and I'll take you and your family this weekend. We're going to be looking to provide co-working space. And that's a really important component to this, because that's going to be the hub where these people get to meet each other, connect with each other, and we get to learn about each other. And I say, oh, Greg, I understand that you do sales and I do, product development. Maybe we can start our own business together, and we can then connect them to WVU's entrepreneurial ecosystem in doing so. In addition, in partnership with the Chambers College, we'll be offering them remote worker and manager training and certificates in order to fully take advantage of this kind of new trend that's evolving from this. The other piece is that we are connecting it to asset development in order to, again, continue to take this great canvas that we have in order to continue to grow it. One of the things that we won't go into, but the ROI on this, and I think this is really important, we worked with John Deskins, his office, for this, is what we found through the ROI is that retention is where we need to focus on, because once we get them here, if we can retain them here in our state, is the return on investment will just continue to compound itself. And so we have hit our time, and we'll be happy to take some questions.
So we don't have any yet from the audience. However, I have a couple, and just kind of thinking out loud, going a step further, let me back up and say, we have people on the call that are in a position to make the kind of investments from the private sector, thinking about the things that they might be able to do to create an environment that would be attractive to not just attract, but also retain these folks. You hinted to a handful of things there. I wonder if you could go a little bit further. For example, are we talking about housing? Are we talking about like multifamily housing, apartments? Are we talking about single family homes? Are we thinking about shared office space? Can you just go a little bit further about some specifics?
Yeah, and so I think a couple of things is one of the trends that we know is vibrancy. That's the term we quite often use, is this idea of vibrancy and supporting amenities. So, you want, housing that is close to downtowns, which is also then can be close to the outdoor amenities. And so how do you connect where people live to the outdoor assets? So can you create a development that's next to the trails, or nearby, still protecting and preserving, the green space, but also then making that connection, because it's a whole lot different when you can go right out your back door before work, after work, during your lunch break. So it's really about this idea of connectivity. When we start thinking about the supporting amenities, what we're doing is taking a look at what are the local breweries, the local restaurants, the local shops, those types of retail spaces are, and we've all been to those towns that have that feeling. You walk down that main strip, or you walk into that shopping district, and you're like, this is cool, this is exciting. And oftentimes there's communities where people live not too far away. So that's what we're really trying to do, is really start thinking about how do we create that recipe for all of that. So those are some of the things that I would, have people really start thinking about. It's really about this idea of access. Is we want to be able to access things easily. That includes our outdoor recreation. That includes our local shops and restaurants. And we want to be able to live near it. And so that could be housing developed, single family. It could be multiple housing. It could be, the housing that's above the shop on the downtown Main Street.
Sure. There are questions flooding in, so I'm gonna share some of these questions that are coming in. But I do want to just go one step further on the question I asked. Is that while West Virginia as a whole offers a lot, no matter where you are in the state of West Virginia, you have proximity to outdoor recreation opportunities. You might not always have access to high-speed broadband, but you'll have access to outdoor recreational opportunities. Are there particular markets around the state? I know you're early in this effort, but is there any focus you want to bring to where you see these opportunities unfolding? The reality is, I think there are some synergies that can develop. As you encourage people to make investments in particular areas, so to speak, geographic areas. Do you want to address that, or is this something maybe for next year?
Well, we're continuing to do our asset mapping and comparing to these other towns. So we're letting the data kind of like, well, where are all the rock climbs? What are the cities that have this energy that something special is happening? And you were talking about housing. Fayetteville has a housing shortage right now. Thomas and Davis, they're getting tons of, and now with VHO coming up to Thomas and Davis, there is a housing need in these towns because people are trying to move there and be a part of those communities. There's a real opportunity there. But when we look at these assets, I mean, for Elkins to have 875 miles of whitewater in an hour and a half, it is just amazing. And so how do we help Elkins have this energy? And because I think it can have that. Or Petersburg, that's 2.5 hours from DC with these right assets. So we're really looking at what is the landscape and where are these hotspots really popping up in West Virginia.
That's great. Some of the questions, Mike, we'll transition to you here in just a couple of minutes. I just want to share a couple of quick questions from the audience here. One question is, how and when do you intend to launch the West Virginia Remote Program? I know this is just announced, 9 days ago, so you're pretty early on, but do you have an idea as to when this will actually come to fruition?
Yeah, so we made the announcement last week that we have the gift. We're still building the program, but we want to make the announcement in January.
Okay, excellent. And another question, is this in conjunction with the state of West Virginia, the tourism department?
So we do have weekly meetings with tourism, and we've been working with, I mean, again, my second week on the job, I think we met with Chelsea and her team. And so we continue to be in close contact and work with them on a regular basis. You know, one of the things I think is important is, you know, part of this is tourism, but really, you know, one of our main focuses is, you know, how do we take those people who visit the state and make them residents of our state, you know? And I know Chelsea and her team have done an excellent job in promoting, you know, the great tourism component of our state, but we're trying to shift it a little bit and really focus on how do we then take those assets that we have and create this vibrancy where people want to live.
Do you believe that the West Virginia Tourism Program has sufficient funding to support these efforts?
I think it's too early for us to answer that, you know, and yeah, I don't know enough about that and to fully try to answer that question.
All right. Last couple of questions. It seems like a missing piece of the conversation is access to high-speed internet. You know, there are clearly markets, you know, Wheeling, Morgantown, Charleston, Clarksburg. I mean, you get onto the long list of cities where we have sufficient broadband access, but I would suspect Fayetteville might be a market that has challenges there. You know, I know that Senator Capito has a big initiative around Capito Connect, bringing broadband access to West Virginia. Do you believe that the timing of that initiative will be fast enough to meet the needs of remote workers that want to live in the heart of West Virginia?
Yeah, I mean, I think as we target areas with the right recreational amenities, yeah, we have to address that or they won't be able to move here and work here. So that definitely goes hand in hand for sure.
Great. Well, thank you, fellas. If there are no other comments you have to share, we've addressed I think we've addressed most, if not all, the questions that were raised. I think your presentation was great. It was exactly what we were hoping to hear. So we'll turn to Mike Green and he's going to talk to us a little bit about how do we encourage investment? You know, how do we in fact encourage the private sector to step up and make the investments necessary to make West Virginia an attractive place to attract and retain these types of employees. So with that, Mike Green is an accomplished investor in small businesses, a high-tech entrepreneur over the years, and brings quite a bit, brings all these resources and experiences in his life together through an investment fund called Mountain State Capital. Full disclosure, I'm among his investors, and I suspect there are quite a few other investors that are on the phone with us. So we're pleased with all the things that Mike is doing. And in fact, just this week, I got a capital call. We're making another round of investments. So it's a pretty exciting time for West Virginia, and eager to hear what Mike has to share with us. Mike, are you ready to go?
Thank you, David. Can you hear me okay? And can you see my screen?
Okay? Yes. Can see your screen, cannot see you, but can see your screen and can hear you fine.
Let's see here. Let's see why we can't see me.
I can see you now.
All right. Well, thank you, everybody. Thank you. I know we're running a little bit late here. I will try to get through my portion of the agenda as quickly as I possibly can. but there's some important things to talk about, and it's always great to be with you and on this beautiful West Virginia day. So what I'm going to be talking about is money, and talking about primarily capital investment in West Virginia. But I have to break it down into a number of different funding options for entrepreneurs, small businesses, large opportunities, and also venture-backed businesses. And ultimately, I'll get to describe to you what I think the availability of capital is in West Virginia, where to find help, and where to find that kind of money. Hopefully this will advance my screen, but it's not. What's going on here? Okay, so let's look at the big picture first. This is a capital continuum slide that I use frequently, and throughout the presentation, I'm going to build upon this so you'll see specifically what it means in West Virginia. Okay, so on the left-hand side, you see the lower risk and lower reward sources of capital, which is traditionally your banks. And if you go to the far right, you'll see venture capital, angel funds, and so on, which we consider to be the higher risk or the higher reward sources for funding. This pretty picture here kind of presents to you in a pictorial way who all the players are as you're looking for capital to invest. And on the x-axis, you have a time horizon or when some of these type of entities like to get paid back. And on the y-axis, you have a general idea of the kinds of money in millions of dollars that likes to be invested by these particular groups. Well, let's start with the banks. And I don't mean to be snarky, and if you hear snarkiness coming out of me, it's part of my personality, but banks in general are risk averse. They are kind of funny about the idea that if you come to them and you have an idea for a business, they actually expect you to pay the money back. It's kind of the nature of the bank. So they look for capacity in your opportunity. They want collateral. They look for character conditions that they call the 5 C's of credit. And it's very, very important for you, if you are a small business, when you go to your bank, to be prepared. But I think it's pretty fair to say that the banks in general are not really set up to help you with your business plan, to really help you figure out where you ought to do all of your businesses, what your sales and marketing strategy is, and so on. So it's a challenge for banks, but clearly a source of places where most people, especially small businesses, will go to first. The good news is that there are a lot of opportunities throughout the country, and specifically here in West Virginia, through a number of organizations. And I'm going to go through this very quickly in the interest of time. But if this presentation is available to you all, you will see the research that I've done here that's going to be available to you if you want to go back and look at some of these places and the links to their sites that you can get help at. Now, the SBA, and particularly the SBA here in West Virginia, does a very good job. And I'll say this about all the organizations that I'm going to be talking about today, and that is, it's pretty clear to me, and probably to most of you, that all of them are understaffed and underfunded. And that's something I'm going to be talking about at the very, very end. So one place you can always go is to your local SBA for support. The federal government, in conjunction with the SBA, has a variety of different loan programs that businesses can go to, including guaranteed loans. Banks associated with the SBA provide microloans to many companies, and even certain government agencies. In this particular case, I pointed to the USDA, has availability through their organization in order to provide funds for equipment, machinery, supplies, and so on, especially obviously in the agriculture department for agriculturally based businesses. You spoke earlier that we had President Barkin on and talking about the Fed, and the Fed, in conjunction with our own EDA and the Benham Foundation, have created this thing called the WVLFC, the West Virginia Loan Fund Collaborative, which is a group of banks that get together that are also, they are available to help small businesses find funding. So it's another source you can go to in the so-called banking community. Well, let's transition a little bit to what we call risk capital. I'll start off by looking at small businesses or entrepreneurs who want to start their own company. And my suggestion is always the same. If you're an entrepreneur, use your own money. It's the best thing that you can do. Save your money at the beginning and use your own money. Therefore, you can control exactly what's going on with your company or your idea or anything you're doing. If you don't have the money, perhaps you have a rich uncle or a local business person in your community that believes in you for whatever reason, and therefore might give you a little bit of money in order to kick off your company. Beyond that, there are three other things that I'm going to be talking about for just a minute here. Angels and angel groups. These are very early stage investors that are taking a risk, usually with entrepreneurs. And they're usually an individual or a group of people, high wealth individuals who can take that kind of risk. Beyond that, you have your venture capitalists, and these are professionally managed companies looking to invest early, do follow-on investments on the winners, but they're very, very oriented toward a very high growth focused investment strategy. And finally, you have PEs, you have private equity funds that are usually looking for managed buyouts, turnaround funds, and they perhaps will take a moderately growth focused strategy. A little bit more about angels and VCs, and a lot of this may be foreign to you in terms of the language. I'm trying to keep it as simple as I possibly can. But angels are, generally speaking, accredited investors with a net worth usually greater than $1 million. They tend to put $25,000 to $50,000 into companies, and they look for a reasonably good return. And return is important to investors. The banks like to get their money back. Investors like to get their money back at certain multiples. And the only way many of these things become investments that are returning capital is as a result of liquidity events. Companies get sold, they go IPO, initial public offerings, and therefore they have a cash asset at the end of the investment period. This is very important to angels, and it's also important to venture capitalists who tend to put a little bit more money than angels in. Usually at Mountstead Capital, as a seed and early stage investor, we're generally speaking going to put in $200,000 to $500,000 as an initial investment, but we like to reserve money up to $1 million or more to support high growth investments that we've made. And finally, private equity. This doesn't happen a lot, especially here in West Virginia, but they focused on more moderate returns from buyouts, turnarounds, and roll-ups of companies. So let's fill in that slide that we had earlier. Here in West Virginia is a very simple slide that shows you on the left-hand side, you have your lower risk, low reward, the SBA, the WVDA, your banks, subordinate member, banks that are giving you subordinate debt. We have organizations like the National Capital Investment Fund. And then we also have, within West Virginia, two entities. There's the West Virginia Capital Access Program, and run by the West Virginia Jobs Investment Trust, and Innova. And I might add here, these folks are really there to help you if you're trying to grow your business. But to say the least, they're also understaffed and definitely undercapitalized. And on the right-hand side here, about 7 years ago, we created the West Virginia Growth Investment Fund. It was the first and only angel fund in West Virginia. Since then, we have the CRAN, which is the Country Roads Angel Network down in the southern part of the state. And then is Mountain State Capital, and we are the only venture capital fund in the state, and practically speaking, one of the only early stage seed and investment capital, venture capital funds in the entire Appalachian region. So that's the big picture. And just to fill it in with a picture here, this is just giving you a continuum of capital that shows you what the growth is in terms of how things are developed from yourself to a variety of different ways to acquire capital and so on. And we'll come back and talk about this in specifics in just a sec. Okay, so the big problem is, now that you've seen a lot of places you can go, this in my opinion is the biggest problem we have in West Virginia. Because a day does not go by where I don't get a phone call or an email from somebody who basically says, help, I need money, all right? And so we're going to come back with a very specific suggestion at the very end of my presentation of what we can do about this, but this is the problem. People do not know where to go. So let's go through a variety of different places where people can go. Now, one of the things we have here in West Virginia is the SBDC, the Small Business Development Center. And this group is very, again, understaffed, underfunded. Deborah Martin and her team do a great job, but they do not have enough people to deal with the onslaught of people who come to them for advice. And I will get to this a little bit later. They don't have a source of funding, but they can provide you with guidance as who to talk to. But there's a good place to start if you're starting a small business. We're very, very fortunate that we have under the Commerce Department, the West Virginia Development Office. Shout out to Mike Graney and his team who are doing an outstanding job. Again, understaffed, underfunded, but they're primarily focused on big things, large opportunities. But there's a place where people can go if they want some support and some help. We have the West Virginia EDA. And again, I'm going through this very quickly in the interest of time. All this will be available if we're able to get these slides out to people. But loan insurance programs, foreign trade zone programs, tax exempt programs are available from the West Virginia EDA if you have the time and the energy and you take the time and you work hard in order to sort through this and find a place for money. The next set of places you can go are local opportunities. And these are just a list of some of the places throughout the state, they're generally local, where people can go if they're looking for money. Again, take your time with these, looking at these slides, and you'll find a variety of different places where you can go. Beyond that, then there are grants available. You may have heard this term about SBIRs and STTRs. These are government programs that are available from many of our federal agencies where you can go to get what we in the business call undilutable funds, non-dilutable funds, I should say. In other words, if you get grants, you don't have to pay it back to the government as a rule. For an investor, this is good because this will complement investment that comes necessarily from either your venture capital funds or from your angel groups. So we always encourage people who are doing research, work through the universities, work through the Commerce Department, and try to get grants. And grants are just a great opportunity for you to get money from the federal government that doesn't necessarily have to get paid back, but a good source of money. And then there's a whole bunch of other places you can go to. If you watch what's going on in the media, you'll see opportunities for crowdfunding from the likes of, most people have heard about Kickstarter. If you're a small business, an entrepreneur, it's not a bad idea. Try to go to one of these sites to see if you can get a little bit of notoriety, a little bit of funding, get the word out. Crowdfunding is always an opportunity for small businesses. And finally, there's a peer-to-peer lending groups, like many of you probably heard about the Lending Club and Prosper.com. These are also places that you can go to for necessarily small amount of funds, at what I call reasonable interest rates. They're not going to kill you that bad. And then within our university, of course, WVU, last year, they put this together through West Virginia Forward. If you go to this particular website, you'll see 100 ways to get startup capital, 100 different ways. So there are opportunities, if you have that opportunity, to go find opportunities to find money. In addition to that, there's Tech Connect. And Tech Connect is primarily focused on the technology sector. But Ann Barth and her team, again, do a great job. They work through grants. They've got a grant called the FAST program, Federal and State Technology Partnership Program, working with the SBA. This is another opportunity to get educated on the SBIR process, the STTR process, in order to specifically find money that's available. Again, Ann and her team do a tremendous job. I recommend that you contact with them. And finally, let's look at angel and venture capital. In West Virginia, I mentioned earlier the West Virginia Jobs Investment Trust, the Country Roads Angel Network, and Innova. Across the border in Kentucky is the Tri-State Angel Investment Group, who through a grant, working with our people here in West Virginia, have been helping a lot of our small companies and entrepreneurs with not only helping them with their business plans, but also trying to find them a source of revenue. And then finally, Mountain State Capital. Bear in mind, we are a small venture capital by venture capital rules here. We're a $20 million fund, which is very, very small. But we are definitely interested, obviously, in finding good investment opportunities here in the Mountain State and throughout Greater Appalachia. I mentioned the Appalachian Investor Alliance. This is actually, again, across the border in Kentucky, but they work closely with Tech Connect, the JIT, and Innova. And their primary focus is to help us bring venture funding and best practices into our community to help people organize their businesses and find funding in order to advance the business that they have. Okay, I'm going to go through this super fast because throughout the whole state of West Virginia, we have a variety of incubators and accelerators in every community. And you'll see this very, very quickly as I go through the slides. And then we have other things like the Coalfield Development Organization down in the Huntington area and the Hub. And Stephanie Tyree and her organization at the Hub do a tremendous job in trying to help people find assets to build their businesses. Finally, our universities and community colleges. We mentioned earlier about the career and technical education community in our universities, teaching people entrepreneurship. This is a big part of our organizations here in West Virginia. I encourage all of our people who are looking for help to contact their local community colleges and their universities in their respective areas for assistance, not only with their business plans and their ideas, but also to help them find funding. So if you summarize this whole thing on this one slide I've put together here with the icons of all the companies that I've just mentioned, you look at it and say, holy mackerel, Mike, you've got a lot of people you can go to here in West Virginia if you're looking for help and funding. Well, let me just pause here for a second and just say this, okay? What you're looking at is the icons, and many of you who are on this call today, on this Zoom, will look at that and say, you know what, I'm looking at the slide and I'm speaking for myself, frankly, I know somebody in every one of these organizations. Okay, this is what we have here in West Virginia. The problem is, where do I go? If I'm a small business, I want to start my company, where do I go for help and where do I go for funding? And at the end of the presentation, I'm going to give you a very specific suggestion of what we can do. But it's daunting in one respect. But this is everybody that we've talked about. So I hope I didn't leave anybody out. It's an impact slide, ladies and gentlemen. But that's the problem. The problem is, where do I go for help? Where do I go for mentoring? Where do I go for funding to meet my needs? Let's break it down a little bit more by talking about the three kinds of businesses. Because in West Virginia, we have three types. We have small businesses, we have large opportunities, and then we have angel and venture-backed opportunities. You all know this. What's a small business? The SBA says 500 or more employees. These are some statistics I throw out there just for your edification here. 30.7 million small business in the US, 1.5 million jobs created annually. This is all pre-COVID probably. 90% of the population represented by small and medium-sized businesses. That's what a small business is. Let's look in the mirror. West Virginia, we are about small businesses, period, end of story, okay? Pre-COVID, post-COVID, 99% of our businesses in West Virginia are what characterized by small businesses, right? What that means is that we are reliant on small businesses, the creation of new small businesses and funding that's going to create these new businesses. This is what we're all about. We are not Silicon Valley. We are not the 128 corridor of Boston. We are not the DC Beltway. We are West Virginia, and it's all about small businesses. Would we like to be able to create the next Facebook, the next Microsoft? Of course we would. But let's focus on what we are and let's be honest with ourselves, okay? The sad news is that half of the businesses that we start here nationally, it's not only true in West Virginia, they fail. And they fail primarily because they're not started up appropriately, the organization is not done well, there is little access to capital, and there's very little access to guidance and mentorship. So all these businesses from my previous slide are all involved in helping small businesses, all of them. You can go to any of them, throw a dart at this slide, and you can find somebody who can help you. But it's a football. What's going to happen here, and the only reason this works at all, is because we all know each other. Because West Virginia is a small state, and the degrees of separation is 1. So if I catch a ball, I will toss it to somebody else, who will toss it to somebody else. So you have a bunch of wide receivers here, all catching footballs, throwing it around, and sometimes the entrepreneur and the small business will get lucky. That's no way to run the railroad, okay? A lot of this is working only because we're small and only because we have a low degree of separation. But you look at large opportunities, like a cracker plant, manufacturing facilities, federal government agencies. There's a move within the state to bring continuation of operation facilities to our state, specifically in the Fairmont, where we have the West Virginia organization there, which is High Technology Foundation, where we're primed to bring federal government agencies to West Virginia because we do have high-speed bandwidth and lots of power there. We'll come back to that in a second. But these are large opportunities: automobile assembly plants, aerospace and defense, chemical, agricultural. The funding for large opportunities, if you go back to my slide, looks like this. Because frankly, if you want to do a large opportunity, you have to work primarily either with the federal government someplace, our terrific Department of Commerce under Secretary Gaunch, Mike Graney in his development office, and perhaps you'll get some help from the WVEDA. And I mentioned earlier the High Tech Foundation, if you want to bring government entities here to the state. This is for large opportunities. So you notice how the slide has now gotten smaller. If you want to do a venture-backed opportunities, the world that I live in, you want to create medical devices, health tech, internet, Internet of Things, SaaS, robotics, autonomous vehicles, all these really cool things are all backed by venture capital. Not small businesses, not your local bank, not your nonprofits. This requires venture capital. This requires investment. And there's no easy way to do this unless you have funding to do it. Now look at the slide. So who's available now? The funding for the angel and venture-backed opportunities is this. Undercapitalized Innova in the West Virginia Capital Access and the JIT, a small group within across the border in Kentucky, a small angel group in the Country Roads Angel Network, and us, a small venture capital fund. Every state in Appalachia invests in this type of funding. I've lived in New York, Pennsylvania, Maryland, and Virginia. Every one of those states, including those to the west and to the south, have their state government providing additional funds and support for the growth of not only small businesses, but tech-based businesses that will eventually be joining private capital in order to grow the economy. So we've got to step up here. West Virginia, zero. We have long memory here in West Virginia. 21 years ago, there was an attempt by the legislature to put money into venture capital. It failed miserably because out-of-state people came in, said they had great ideas how to build venture capital in West Virginia, took our money and ran. Historically, that's what's happened around here. We can't afford to do that. We can't afford to say to ourselves, well, it didn't work 21 years ago, so we don't want to do it again. We have to continue to invest. All of our surrounding states invest. We don't. We need to fix that. I usually end up my presentations with asking questions, and eventually I like to get to the last question, because when we give our presentations, we're really good about telling you who we are, what our problem is, where we need to go, so what does it mean? But when it comes to the now what question, oftentimes we just go, oh, I don't know, let's have another meeting. Well, I don't believe in that. I think we have to do some very specific things. Who are we? Let's be honest. We're a small state with way too little investment capital. We are losing population. Our death rate exceeds our birth rate. Our kids are leaving in drones. They're seeking jobs and opportunities elsewhere. Every time I give a presentation in a university, I ask, how many of you kids are staying here in West Virginia? And very few raise their hand. They're leaving. It was brought up before, David brought up the education ecosystem, and John brought it up. This is something that needs improvement, because if we're going to get people to stay here and to come here, we need to attract and have better teachers, and we have to pay them more. This is my opinion. And I think I've earned the right to talk about this after spending 7.5 years on your state school board and president of the school board for a number of years. I think I have a pretty good idea what has to be done there, but we do have to continue to work on our education ecosystem, although we have some really good stuff going on in career tech, simulated workplaces, and so on. And this next statement I make at every presentation: the business community is the direct beneficiary of what comes out of that education ecosystem. So I'm encouraging those of you who are in the business community to get out of your office once a quarter and show up in a middle school and a high school and show these kids what a business person looks like. They don't have that frame of reference. And if you're going to complain about the education system, get into the system and tell them how you want to modify the curricula that matches the jobs of today and tomorrow. If you, the business community, doesn't step up, how is the education community going to know what we ought to be teaching our kids? And finally, I'm going to jump on this bandwagon. Not only do we have an infrastructure problem in our roads and our bridges, but I think you all know what it looks like in our cellular systems and our broadband systems. You had a great presentation by Greg and Danny just a few minutes ago about attracting people here to come to West Virginia. They're not going to come here unless we have good broadband, which is critically important to not only education, as our kids are sitting in parking lots today, if they can possibly get a connection into a broadband connection by their school or some hotspot. Most of you are listening to me today are on a very nice broadband connection, so we can hear and talk to each other. But isn't it criminal that a lot of our kids across the state can't get the same kind of access? And this is not only important in education, it's clearly important for economic development and equally important for telemedicine in the future. We keep talking about it, but how are we as a state going to be participating in that if we don't have an appropriate broadband system? We've got to focus on this. This has to be a major priority. And finally, I'm going to give my opinion about us. We're very deficient in our marketing. We've got to figure out a way to sell ourselves better. I want to wrap this up. So what are our priorities? The first thing is, As a West Virginia, you got to believe in us and invest in us. We have rarely invested in us. The state has not invested in us. We need to focus on creating new companies, new jobs, and equally important, new careers. Jobs are important. Careers are also important. We have to attract newcomers, as the previous speakers told, to come here, work here, and live here. And we have to encourage our expats to come home. We all talk about it, but let's make a good reason, have good reasons for them to come home. But in order to do that, we have to invest money. We have to go back to this whole discussion about capital. Let's talk about marketing one more time. We have, as Greg and Danny said, we have got one of the best stories to tell about the combination of the quality of life and the quality of career. I use the term exploit our expats. We have some great ones. You know about John Chambers. You heard about Brad Smith. You know about Ray Lane. You know about other people that have contributed to West Virginia who come from here. We got to get them back here. We need to exploit that. We need to tell our story clearly, but we have to spend our money and we have to do it right. We have to do it that way. Specifically, this is a recommendation, a suggestion I make, and this is not something that we have to reinvent. This has already been invented. We need a concierge service. For those of you who are in business today or an entrepreneur, you need to have one-stop shopping. You make one phone call and you need one place to go if you want help. And where am I going to get help to build my business plan? You would be amazed the kind of business plans we get from people who say, here's my business plan, send me money. We need to help people create a business plan that makes sense. And these are the kind of functions I've listed here. And again, I didn't make this up. I'm not trying to reinvent this wheel. This has been done before, and the references at the bottom of your screen are states that already do this. We need to do it. So now what? Well, I think we're at the point where we need to demand action and results from our state leaders and our legislature. Okay, we're coming up on a new legislature in January. We know it's only 60 days. We hope they don't get hijacked by something, which normally happens in our state. But we have to demand that they invest. Investment is something that we just have not been able to do enough of in West Virginia. And we have to invest in our future and our present today. And we have to support our entrepreneurs and our businesses. And we have to demand a new sense of urgency. One thing as a West Virginia that drives me crazy, because I'm an impatient person, is the lack of sense of urgency. We don't have time. We have to have the state. And Brad Smith will tell you this, and John Chambers will also tell you this, that the state has to be a player here. We have to have a combination, not only the state, but also the private sector working together. So I know that was whirlwind, David. I probably took a little bit more time than you probably expected, but I feel passionate about this. I hope that people understand that my passion here is for a better West Virginia for all of us here. It takes money, it takes commitment. We need to work together both in the private sector and the public sector in order to make the state the great place that it already is and a place where people are going to want to come to.
Mike, that was just perfect. Thank you very much for the spirited and well thought out remarks. There are a couple of questions, and I encourage anyone else that may have them. We'll spend just a couple of minutes and we'll turn to wrap up the panels, and I'll go back to John and Mark to wrap up the budget conversation. A question, do tax-exempt bonds offer a better rate of return than stocks, and could that be a source of capital to start a business if one was unable to secure a bank loan? I'll take a quick crack at answering that. Municipal bonds, specifically we'll say industrial revenue bonds, could very well be a source of funds, a source of capital for specific projects sponsored by a city or other municipality. They historically have not produced this as high a return as stocks, but they could be a very attractive source of funding, long-term fixed rates. Mike, if you want to, do you want to comment on that at all?
I think that I would defer to that question to go to the EDA and others that are more capable of answering that. I bet you John can provide a better answer than that. I'm not an expert on that particular subject, David, to be honest with you.
Sure, not a problem. The other question is, how would you point the private sector? And frankly, as I listened to you kind of wrap up, I felt like you were addressing that question in your remarks. How do you engage for advocacy with the legislature, for example, and of course, through our private investments. As I think about, my wrap up points, we have lots of competitive advantages. We've been talking about them all morning, but low labor force participation, and frankly, insufficient investments to bring about a more diverse economy, and it's caused peaks and valleys, significant peaks and valleys. And if we can do more to encourage entrepreneurship and of course help people overcome barriers to good employment, I think a good job, as people will often say, cures lots of ills. The current environment, you know, as we talked earlier about the COVID-19, the current environment, of course, creates kind of brings about yet another of our natural advantages. And we talked a bit about that social distancing. I think the folks on this call have the ability to act, but we must do it quickly if we want to take advantage of this wave, if you will. You know, how do we make investments, impact through our investments, impact through policy decisions, and you didn't use these words, Mike, exactly, but the stories that we tell others. You know, how do we tell people about the things that are happening in West Virginia? And I hope that people are leaving today's session with lots of good talking points and lots of good reinforcements of some things we were well aware of. We have lots of natural advantages in West Virginia, but how competitive did we believe they were nationally? And do we believe that West Virginia is poised for a wave of development? There's a lot of personal wealth in West Virginia. Mike just showed you lots of examples. People are putting money to work, but there are even other opportunities. And one good example that is really, I'm not sure has really affected West Virginia yet, but a federal program like the Opportunity Zones and Opportunity Zone funds. These are designed to attract additional capital from throughout the country and to invest in targeted distressed tracts. They're all over our state. I think literally every county has at least a tract or two into which these funds can be invested for tax advantage, to defer capital gains, et cetera. So whether you have the resources and the desire to make these investments or not, or you have the contacts and influence, if you're an accountant, a banker, an attorney, or if you're in some position to influence the investment decisions of others, you know, Mike and I and Greg and Danny and John and Brian, we all challenge you to do what you can in the next 12 months. How do we act? How do we put into action the themes that we've been sharing all morning? I thank everyone that has contributed to our panels and everyone that has participated as an attendee. I know we want to try to wrap up here with Mark Mukow. Is there anything, John, are we ready to go? Is Mark prepared?
I'm ready to go.
Oh, excellent. You have the control, so to speak.
Okay. Let me. Are my presentation ready to go? Let's see. Folks got me? Hello?
We can see it. It looks great.
Looks good. Okay, ready to go here. I'm going to talk real briefly about where we were before the pandemic hit. Through the first 3 quarters of last fiscal year, we actually had a positive 0.3% revenue growth, which is very good because our target for the whole year was a negative 1.3%. So we're well positioned to balance budget, actually have a surplus, a positive growth in both sales tax, personal income tax. In fact, the third quarter, January through March, was our best quarter for both income tax and sales tax. We were up 4% in income tax and 3.6% in sales tax. So it looked pretty good. And then the pandemic hit, and pandemic, a major decrease in revenues. Now, it was fortuitous that we were estimating a 6.2% decline in the fourth quarter revenues, mainly because of weak energy sector and expectation of slightly lower income taxes. But we ended up getting well over 25% decline. And if you include some adjustments on the income tax reserve fund, it was about 27% decline. That's about $394 million downshift from the prior year, big downshift. Now, half of that downshift was due to a decision at the federal level and the state level to defer the due date on income taxes, both corporate and personal, from generally April 15th to July 15th. That was turned out to be about a $200 million shift. But in addition to that, we had close to a $200 million reduction in other areas. Certainly withholding taxes for personal income tax were down about 10% during the quarter. Sales tax was down a bit during the quarter. Corporate tax collections were off by about 2/3. Severance tax, which went into that quarter down about 30%, in the last quarter was down 68%. So big impact on the energy sector. And finally, lottery revenues were down $10.7 million. That's because the casinos had to close temporarily, and certainly various other lottery outlets were hampered as well. So we had a major budget gap to close. The legislature was out of town. How did we close the gap? Some fortune on our side on both the expenditure and the revenues. I'll talk on the revenues. We ended up coming up with about $103 million in one-time revenues. I'll talk about the big three. We have an income tax refund reserve account to guarantee payment of refunds when revenues are short. We drained that fund of $23 million to pay income tax refunds so as not to hurt the overall cash flow for general revenue. Once every 10 years, we have a liquor license retail renewal program that's due on July 1st. We encouraged all those liquor license renewal people to make payment before July 1st. And that was close to $16 million of additional revenue. And then the Federal CARES Act provided us with $1.25 billion. We were able to capture 57 million of that for expenditure reimbursements. That contributed to the revenues. On the expenditure side, we went into the pandemic with reserve funds for Medicaid of about $150 million. At the onset of the pandemic, the national government gave us an increase in our FMAP, federal matching percentage, by 6.2% for all states. And we used the reserve funds and the MAP funds to reduce spending authorizations. And we also had accounted for additional spending expirations of about $13 million that we were expected. So we basically cut spending authorizations by $199 million. The good news is that that extra 6.2% on Medicaid share match continues on, and we're going to get another $100 million probably in between July 1st and December as a result of that. So that'll help us maintain the Medicaid funds, even though we reduced the authorization spending to balance the budget. With that, the revenue piece that was $103 million, we still had $199 million that was closed by the expenditure reductions or authorization reductions. So ultimately ended up 5.5% below, even with the extra $100 million of revenue compared to the prior fiscal year. So it's a pretty big gap there, but we managed to balance it out. And not only that, because of reduced spending by various state agencies or whatever, we had a budgetary surplus of $28 million at the end of the year, which $14 million went to the rainy day fund, and under $14 million was available for various expenditures. Moving on to 21. In 21, we have the first quarter numbers. Now, the good news for 21, the estimates were developed prior to the pandemic, so that's bad news. But the good news is that we had a $200 million income tax deferral, about $144 million in personal income taxes, and $56 million in corporate income taxes. So that put us in a pretty good shape for fiscal year 21, at least to minimize the damages. And because of the recovery going on in the economy, we had an unexpected tick up in the sales tax. Certainly, we weren't expecting 6.2% growth in the first quarter, but that was a very strong first quarter. You notice the personal income tax up 22% and corporate up 110%. A big part of that, again, was $200 million that was deferred into July. We still had some weakness in insurance premium tax, but that was balanced by other revenue growth. And overall, 12.8% ahead of prior year for the first quarter. So that's going to help us out as we move forward for the rest of this fiscal year. Certainly, other than the $200 million carryover, the revenues were going to be a little bit lower than last year because last year we had higher employment than this year. As we need a continuing improvement on the V-shaped economy for the rest of the year. And if we get some additional improvement, we should be very close or reasonably close to making the estimate for the fiscal year 21. Now there's areas of weakness and areas of strength in revenues. The weakness, certainly energy sector has been hit very hard by the economic impact of COVID and other economic factors, and therefore severance tax is down. Employment's a little bit lower, so that has a negative effect ultimately on personal income tax. Leisure has been hurt. There's less travel to and from work, so motor fuel excise tax collections have been suffering a bit. Racetrack video lottery numbers are down a bit because the casinos aren't quite up to full capacity compared to prior pandemic. We're working at home. We got some insurance rebates, especially on automobile insurance. That's lowering the insurance tax revenues a little bit. And certainly business losses and less employment could also contribute negatively to the income taxes, as well as the state unemployment tax. Balance that to the areas of strength. Stay at home. The collections that are really looking strong this year are beer tax, wine tax, cigarette tax. Limited video lottery gaming is up. Overall lottery numbers are up this year, mainly because of limited video lottery gaming. Stimulus at the federal level has certainly also helped our sales tax and our motor vehicle sales tax, as spending on goods has been relatively strong. So those are the areas of strength heading through the fiscal year. Revenues are going to be a bit weak for all 50 states heading forward, at least through fiscal year 21, and certainly probably also fiscal year 22, with probably recovery by fiscal year 23. And if there's any questions available, I think we're running out of time anyway. Feel free to ask.
I don't see any questions appearing in the Q&A, so John?
Well, first and foremost, I apologized earlier that the West Virginia Economic Outlook report wasn't online yet, but it is now online. If hopefully many of you noticed, I posted the link to the West Virginia Economic Outlook report in the chat earlier. If you missed it, or if you want to go back later, you can just find it prominently displayed on the webpage at the WVU Bureau of Business and Economic Research. So anyway, that report is up. But now I will apologize for scheduling this thing to be too short, because we had so much stuff to talk about. We are over 21 minutes already, but we had some really fantastic presenters there. And so I think it was worth the extra 21 minutes. Mark, thank you. And certainly thanks to Mike, Danny, Greg, David, and President Barkin first off. So again, this has been the 27th annual West Virginia Economic Outlook Conference. I think it was awesome online, but I really, really, really hope that we will be back to in person so I can see everyone in person next year, and hope everyone is doing well during this crisis. Thank you all so much. Have a good day.